Team, we're down in beautiful South America in a specific region called Patagonia. It's known for its mountains and guess what? Rock climbing as well. So there's a company there that specializes in selling rock climbing equipment. Now they need our help to figure out what forecasted. So this company uses their historical EBITDA margin, applies that to forecasted sales, and that helps them forecast their EBITDA or their future earnings. So how can we use the information in this question to forecast EBITDA for them? So first things first, we need to understand that the formula for EBITDA margin is just EBITDA divided by sales. So like a lot of our other ratios, this just basically tells us for every $1 of revenue generated, how much EBITDA is that resulting in, right? So what we need to do is first use this financial information to calculate the company's EBITDA, and then we can calculate the EBITDA margin by applying it to that sales of $600,000. So when it comes to calculating EBITDA, our starting point is typically net income, and then we'll add back items like depreciation and amortization, income taxes, and then interest expense net of any interest income. So it looks like we are given that. So for step one, let's go ahead and calculate the year 4 EBITDA. So starting with net income of $100,000, we'll add back depreciation and amortization, which is known as D&A, and that is $25,000. And then we'll add back income taxes of $15,000, and then we need to add back both the interest expense net of interest income, right? So there is a little wrinkle there. It's going to be an add back of a net of $10,000. So that results in EBITDA of $150,000. So now we need to calculate the historical EBITDA margin for year 4. So EBITDA is $150,000, divide that into year 4 sales of $600,000. That tells us the EBITDA margin is 25%. So now we have the information to go ahead and calculate forecasted EBITDA for year 5 based on forecasted or projected sales of $750,000. So as you can see in step 3, forecasted sales are $750,000. We'll multiply that by that historical EBITDA margin of 25, and that tells us forecasted EBITDA for year 5 using this method for this company is $187,500. So that's the correct answer. Now, if you got this wrong, one thing most students really miss is this interest expense net, right? Because if we're going to add back interest expense, we also need to exclude interest income related to any debt, right? And that's the $5,000 that you see there, right? So make sure you understand how to calculate EBITDA and then how we can use the EBITDA margin ratio to assess profitability and maybe assess future profitability based on projected sales.